This presentation is the first part of a 3-video series designed to help you and your financial advisor create a tax-efficient retirement strategy. In this section, you will learn about how marginal tax can impact your retirement strategy.
I'm sure you've seen tax brackets before. We live in a marginal tax system, which means that each additional dollar of income gets taxed at the bracket rate that it falls under. So in this first bracket, from $0 to $19,750 of taxable income, you'd pay a 10% tax rate. And then any dollars that fall above $19,750 but below $80,250 gets taxed at the next rate, which is 12%, and on down the line. In this way, higher income earners pay a higher overall percentage in taxes than lower income earners. And of course, this chart is for married people filing jointly, but the same structure applies to other filing statuses, such as single or head of household. The numbers are different. This might be an easier way to visualize that marginal tax rate system. As you move to the right along the bottom, you're adding ordinary income. And what you'll notice is that each dollar that falls in the 10% bracket gets taxed at that rate. And then once we cross over the threshold into the 12, each dollar in that bracket gets taxed at that rate, and so on and so forth. You'll also notice this graph is shifted a little bit to the right. It doesn't start right away at 0 as the brackets did. And the reason for that is the standard deduction. And everybody gets at minimum that standard deduction unless you take itemized deductions on Schedule A. Two key planning opportunities become apparent when you look at a tax map like this. The first is this jump between 0 and 10%. The second is the jump between 12 and 22%, both really significant jumps in marginal tax rates. And then for higher income earners, we've got this jump between the 24 and the 32% tax bracket. So when you hear people talking about maximizing the tax bracket, what they mean is getting as much out of your accounts at your current rate as possible without going into the next marginal rate.